Hi guys, we'll get started in a minute. Just let me know if you can hear me. That'd be great. Thanks. Okay, hopefully that was enough time to go through that. And just quickly, as we're going through the webinar, feel free to ask any questions and or any thoughts or queries you might have. Just type them in, and I'll get to them at the time. It's probably better to go through, ask questions as we're going through it as the topics come up. So the topics we're going to go over is the RBA, another rate cut in November. I mean, as some of you might know, we had the rate decision yesterday from the RBA where they decided to cut 25 basis points. And now we've got some very interesting price action, both in futures markets and in the Aussie. So we're going to look at what that means, the implications for the Aussie. And then we're going to just have a quick look at Spain and see what's going on, just because there's so much price action sort of focused on, is Spain going to apply for a bailout, what's it doing, over the weekend, and the implications that'll have for the US dollar and particularly the euro. And then we're going to look at China. It's a week off in China, which tends to be, or can be the time China decides to move in terms of policy. So we're going to look at what we can expect, briefly go over that, and then we're going to go into more detail about the Bank of Japan. So what we can expect from the Bank of Japan. They'll start their two-day policy meeting tomorrow. That'll be Thursday in Asia, and we'll go into that, what we can expect and the implications of price action from the yen, and then we'll just look at a pair that I find really interesting, which is the Euro AUD. It's sort of very interesting right now. So we'll go over that. Okay, so getting into it, the RBA. So the reason why I bring up the RBA today, obviously the RBA decision was yesterday, and they had the 25 basis points cut. Now, what Governor Glenn Stevens came through and said at the time, was just basically saying the outlook for the global, his first line basically saying the outlook for growth in the world economy has softened over recent months. Now, the key sort of takeaway from the statement is the fact that in previous statements, especially in the last statement, the RBA hinted towards possible easing, but they said there needed to see material deterioration or significant deterioration in economic conditions offshore, and by offshore they meant China, the US, and Europe. Now, in the latest policy statement, or the statement by Glenn Stevens, they've come out and said, not much has changed. I mean, it's a little softer, but not much has changed. Yet we're still going to cut policy. So it's really confusing, and that's why we saw price action in the Aussie, spike down so much following the RBA's decision. Because I mean, there was all this sort of mixed rhetoric. I mean, everyone recognised the fact that there was scope for an RBA cut. I mean, if you look at the data, as I'll go through in a little bit and what have you. There was definite scope there for an RBA cut, but we'd sort of looked at these words from the RBA, in particular, the Governor Glenn Stevens, and said, there hasn't been that deterioration in conditions offshore. I mean, not much has really happened. I mean, yes, as he stated, it's a bit softer, but that shouldn't be enough to materially impact their decision, unless they're sort of admitting they should have cut rates first. But who's saying that? So today what we had is this, just into the trade balance data here. And as soon as this was released, we saw another spike down in the Aussie. And the reason for that is because yesterday's statement tied into China a lot and into Australia's terms of trade. Now, a big part of terms of trade is the trade balance data. And what the concern is slowing growth in China can continue to hamper trade or exports in particular going forward. And, we agree with that. We expect that to be the case. We've expected that to be the case for a while. So what the market takes this to mean is, more cuts from the RBA, as we can see all over the headlines on Bloomberg or wherever you might be looking, or on, FX Street. And then in terms of what we're looking at, from the actual data, we can see that big drop in exports that people, weren't expecting comparatively to the imports figure. And that, that does spell, worrying times ahead for Australia's terms of trade. Now, the RBA touched on that, or in particular, Governor Stevens touched on that yesterday when he said there's, possibly 10% decrease in the terms of trade, in Australia. But at the same time, he's hinted towards the Aussie dollar remaining at relatively high levels. So what does that tell us? Sometimes with the RBA, you sort of got to read between the lines, and you've got to sort of understand that they can't come out and be overly bearish. If they did that, people start panicking. So what we do is we look at that, and if we connect the dots, we can almost say that they're saying the terms of trade should have the deteriorating terms of trade in Australia should have resulted in a lower Aussie dollar, or revaluation in the Aussie dollar lower. And that's true. I mean, that's what should historically happen. If we look at a price graph, we price the Aussie dollar against the Aussie US against Australia's terms of trade. There's a massive correlation there until recently. It's not really that. It's not reflective at all. Even when the terms of trade started coming back up earlier this year, or towards just after the middle part of this year, and we still didn't see that reflected necessarily in sustained price action in the Aussie. So, what that tells us is there's other, things going on for the Aussie, which is understandable. But it also means the RBA recognizes that. So now, there's a chance they might look at that in more detail at their November meeting. So what that has led to is this, interbank, or this pricing in across the markets actually. Not just interbank futures, that says, they're going to cut rates again in November. Now, we can see from the statistic there I pulled up, that was something I just got a few hours ago. And if we look at interbank futures markets, it's about 60% chance of a cut in November. And now, I mean, that's massive, because, I mean, in order for the Reserve Bank to continuously cut twice in a row, as we saw earlier in the year, they're basically admitting there is almost a structural problem with the Australian economy, or the structural problem as a result of what's happening offshore. And that's a big thing, because that means the RBA, without saying it, is almost bearish on the Australian economy, which is massive for obviously investors locally, but also for those people trading the Aussie and Australian equities, or bonds, or fixed income, whatever you might be trading. But the key question you've got to ask yourself, is there enough essentially to force the RBA to cut? Now, if we look at recent economic data, if you go to FX Street's website, you have a look at the economic calendar there. It's a great one. It's got all the information you need to look at, and in terms of Australia, what the RBA looks at, and what you see is essentially that there is a deterioration over the last month. There has been a significant, well, not significant, but a deterioration in economic data out of Australia, which has provided scope for a rate cut. Yay, we all knew that beforehand, so that's not a big surprise. What else is there to look at? All right, China. They mentioned China yesterday, or Governor Glenn Stevens mentioned China yesterday. That's all well and good, but we don't expect much to change from China. I'm going to go into more detail about some policy decisions we might see from China, but the overall impact of the impact of coming from Beijing on our rates locally isn't going to be significant in our opinion, or at least it shouldn't be significant enough to force the RBA to cut. Again, there is scope, given some parts of the Australian economy are very soft, but you got to remember the RBA has to take a broad overview look. They can't attack parts of the economy with rates. Rates are a broad monetary policy tool to target the whole economy. So you can't, essentially, target the points that they want to, unless you're talking about coordinated intervention, which is, not something the RBA does right now. Sorry, excuse me. Fundamentally, we also want to look at what's happening in the US and Europe. Europe, we're going to go through after this what's happening in Spain. That's probably the number one talking about. In the US, we're not expecting much to change. I'm not going to go into detail, but basically, the US isn't doing that well. It's come off, 4.1% GDP end of last year. Q2, we're looking at, off the top of my head, I think it was 1.3%. That's not good. I mean, that's a big, deterioration not deterioration, sorry, but a slowdown or a worsening of the figures, which, it's the reason why we saw, QE3, and why we expect, they will go ahead and do with more quantitative easing. But the focus of that basically means not much is going to change over the next month while the RBA is making a decision. In fact, regarding to the US, we don't expect much to change until the elections afterwards. And then even then, there's probably not going to be a whole lot unless you are looking at the fiscal cliff. We expect to see, broad, once we know what parties are in, then the market can reprice and really see what's going on. In Europe, it's a similar situation. The only thing that really can happen is sovereign bonds and yields start to get so bad that, Spain and other countries are forced to apply for a bailout. But again, that might not happen, especially if we see this current rhetoric now anyway from Spain or Madrid, where it's saying they're not going to apply for a bailout, at least in the near term. Anyway, I'll go through that in a bit. So what do we want to look at? The implication for the Aussie. Here we can see AUDUSD. Now what I've got here is obviously simple daily chart, and what we're looking at is the recent sort of price range. Now we'll see, again, that 106 level, as we know, is a big level on the upside. I mean, we can tell that chart, looking at charts, 106. We can also see, big build-up of orders there, which creating a big ceiling for the Aussie. Now, it's not an unbreakable ceiling. It, could obviously be broken through with enough momentum. The only thing is right now, this sort of low liquidity or these thin market conditions, it does make it less likely we get a breakthrough on the upside, but it doesn't rule it out entirely. Now, on the downside, it's a little different. That sort of it's a broad sort of 1.160 sort of to about 1.012. 1.0160. Sorry about that. To 1.0200. Well, that sort of broad support level is, is significant for this pair. But again, it's not as significant, I think, as 106 on the upside. So, the possibility of a break anyway is more pronounced, we think, on the downside. Now, the technicals, again, are frustratingly sideways in a lot of cases for the Aussie. And that's to be expected some of the time. But right now, they are just very frustratingly sideways. And we can look at, there are some bearish signals coming through, even possibly suggesting we're not in oversold territory yet. But overall, we think, if we do clear a bunch of orders around sort of between this 101 level to 102, we can open up the test to see lower lows below parity. So the key points there we want to look out for is we don't see a lot of orders around this area, but we do want to watch sort of 98 to 99. That's going to be a big level, and then beyond that we want 96, and then beyond that there's a build up around sort of 94, 95. The key thing to watch out for is obviously this break on the downside. Once we get that, then we can really say we can almost once we switch to hourly or intraday charts, we can see we'll be in a bearish pattern as we are now, and that'll be a continuation on the daily chart, which is obviously solid confirmation from a technical standpoint at least. Okay, so I'll get back to the Aussie, but just want to go through quickly what everyone's talking right now, as in, depending on what part of the world, tonight in Asia or today in Europe, which is Spanish and German bonds. Now, the key thing to watch out for here is the spread between these bonds, which is the bottom part of this graph here. So what we're looking at right now is spread around 4, as you can see. Now, the key thing to take away from this is the spread, whilst it's high, I mean, that is a high spread, is not as high as it's been. So it's not up that worrying sort of 6% level. Now, the worrying, where it's going to start getting worrying for Spain anyway, is if it gets around sort of 5 and above. That'll mean borrowing costs in Spain are very low, very high, and in Germany the bonds are very, very low, 10-year. By the way, this is the 10-year Spanish bond and German bond yield. Up top here. So in Spain, we can see right now we're looking at they're not great. They're around 5.75%. But again, the same thing. They're not up towards that really high as we saw, up towards and what have you. So, things aren't looking bad, which is, well, terrible anyway, which is why Spain isn't, or Madrid isn't, effectively saying we're definitely going to apply for a bailout. Despite the price action, I don't know if you guys saw, but the price action yesterday, there was a lot of sort of build up around, Spain's also going to apply for a bailout, and we're going to get, we're going to get an activation of the OMT program eventually once that happens. But, that didn't come through. Madrid was quick to come out and say, no, we're not going to apply for a bailout. We expect the same thing to happen this weekend. But we just want to make sure, that doesn't happen. So again, what do we want to keep an eye out for in terms of this? Just keep your ears to the ground for anything coming out of Madrid. Got to keep in mind, politicians are politicians, so they're not going to, they're not going to talk outright. You've got to definitely learn to read between the lines. And the way to read between the lines is what I would do anyway, is watch the rhetoric and, take it at face value. But watch the figures, the key figure that the market, everybody basically is watching is Spanish bonds. So, if we start to see that yield kick up, we want to be cautious. This also creates an interesting situation for the Euro AUD. The Euro USD. So the point here is that basically what this sort of Spanish rhetoric, or if this what happened from the ECB in terms of their OMT outright monetary transaction program is just a quick recap. That program, by the way, is where they said, they'll buy an unlimited amount of sovereign debt to cover borrowing costs for struggling peripheral nations. Now, what that means is essentially they've become lender of last resort, and they're going to step up and do what's needed to save the euro. As ECB President Draghi so publicly announced a few weeks ago. Now, what this means for the euro is, does this create this floor for the euro? I mean, what we usually see is if we're going to see this kick up in Spanish bonds and associated kick down in German 10-year, will we see a reflection in the euro? So usually when that happens, we're going to see a push down in the euro. But again, once we start to see that push down the euro, and that's associated with the rise in Spanish borrowing costs, then the Spanish government the ECB, Spain will be forced to apply for a bailout, because once those borrowing costs rise to unsustainable levels again, and they stay there, then Madrid's not really going to have a choice. They can't do anything else. They're going to need the money, or they default. And we all know they're strongly on the lines of not defaulting, as very understandable. So that means essentially, if that were to happen and Spain were to go and apply for a bailout, what that price action yesterday highlights, and highlights very interestingly, is that the market is going to take that very well. So yesterday we saw, even the rumors of it move price action, especially in the euro. But so then, you've got to think, what would, if rumors can do that, what would an actual announcement of a Spanish bailout do? And the answer is, we think anyway, will be a big push up for the euro, likely, depending on price action, but at the moment's price action, above 130 possibly. Depending on where orders are sitting at the time. But that creates essentially, there is some downside for the euro in terms of Spanish borrowing costs, or borrowing costs in Europe have a bit to move before that happens. But the ultimate, takeaway is that there is a floor there. There is, a floor in the euro placed by the ECB, essentially. Where that floor is now, that's a different question. I mean, it really depends on price action at the time again. But, if we were to say it right now, we would probably say around 123, 124. So that, if we're looking at a trade setup, that's where we'd set up ourselves. But again, will depend on price action at the time, but at least we know there is some upside potential with limited downside, if in that particular case. That's excluding everything else happening in the rest of the world. But all right, now we're going to go through. Actually, no, we'll go through China first, and then we'll go into price action in Euro Aussie, which I think is the most interesting pair right now. But China, the reason why I have this up, for those of you that came to last week's webinar as well, you'll recognize this. It's basically China's open market operations over the last little while. And what this is China stepping in the market to intervene, not buy or sell securities through its OMO program in China's financial markets. And why this is significant is not only does it have sort of a flow of funds effect on some currencies, mainly the US dollar, but it also has a risk sentiment effect on commodity currencies. Now, commodity currencies, by and large, I'm talking about the Aussie and the euro. So what this means, if they keep doing this, is essentially another form of stimulus for the Chinese economy. So, what do people take stimulus as? Stimulus is a big bonus during times of economic uncertainty, like right now. So what we want to watch out for is the numbers. Now, this week we don't expect anything to happen because the Chinese market's on holiday. But next week, but in terms of other policy measures, we do expect things to happen. Now, by the way, if you guys want to get these figures, as I said, for those of you that were around last week, just you can get these figures either from our platform or forex.com, or you can try and find them on different websites around the place. What you want to look out for now, anyway, the key term is reverse repos. So what sort of reverse repo magnitude of reverse repos the PBoC is selling into the financial market, and a big amount is probably above 150 to sort of 200. Max is about 290 billion yuan per day. Over the week, maybe a bit more, but anything sort of more than 400 in 1 week is record breaking, so that'll be a big mover. Anyway, getting into it, so we'll go back now and before we get to the BOJ, and we'll look at the Euro AUD. Now, the reason why, one sec. Sorry about that. The reason why I went through China first, because it's going to be a determining factor on what happens, like I was explaining with commodity currencies, including the Aussie. But the reason why I've got this pair in particular up is just because it has broken through a very nice level, technical level there, just above 105, which is about 105.5. Now, this creates the dynamic. Essentially, is it free to move? You move even higher. So if we look here, we can see, when we're around this area, there was a big build-up of orders, which created this sort of near-term ceiling for this pair, and now it's broken through. So what do we want to look for? Is this paving the way for a push even higher? And is this the start of a long upward trend, which we can draw neatly on a chart up through here, which might even pave the way back up to towards 130. Now, on the fundamental side, we look at the supporting factors of this. In the long term, they support this theory. I mean, the only real big sort of driver of AUD strength, which would create a bit of worry for those of you going Euro AUD long, is the yield seekers out there, which there are always going to be some, especially from the banks and hedge funds, are going to be looking for the Aussie dollar, just because the yields here are so much more attractive than pretty much anywhere else in the world. And there's also the flow, which also sort of creates the flow from central banks. Now, if we take that out, fundamentally, I can go through in about 10 minutes why the Aussie is overvalued. But the most important thing is, or the most important points to note down, decreasing terms of trade, which is going to, we think, eventually catch up with the Aussie. It just might take a while once we see the yield seekers leave the Aussie. And there's also deteriorating economic conditions in Australia. I mean, there's no question the mining-driven boom of the mining-driven Australian economy is slowing down. It's sort of ending this period of unreasonable growth that was driven by the steroid-infused Chinese economy. Now that's unwinding. We're seeing that flow through into Australia, and again, that's going to create a fundamental flaw in high valuations for the Aussie. So that in the long term anyway supports the Euro Aussie long position. On the Euro side, we can see we can see the same thing as we're going through before with what's happening in Spain and the ECB and that sort of floor for Euro USD. Again, that'll feed into Euro AUD and essentially create a reason why the euro can be capped at the losses, but not on the ceiling. Again, we want to watch out, for more information over the coming weeks to make sure this is going to be the case. But essentially, if it is, then can we see a nice push towards 130, possibly even higher? Again, above 130 is going to be a lot of resistance, especially with the build-up of orders we've seen around sort of 129, 130. So above that level, it's a bit more risky, but there's definitely scope at least for a push up towards that. We more favor up to around sort of here, which is about the so let me just get my chart. It's about the so about the 128 sort of 128 sort of level, 128, 128.5. Once we see that, then we're going to see a nice, we think we're going to see a nice, well, if it gets that high, could see a nice plateau and maybe a trade and a reconsolidation. But again, it'll depend on price action at the time. Now going into the BOJ and JPY. So we've got the BOJ meeting expected, the BOJ meeting starting tomorrow and concluding on Friday when we get all the results, which should be fairly interesting, or actually in this case not that interesting. In fact, we're not really expecting that much from the meeting at all in terms of whether they're going to expand the asset purchase program again or commit to anything new. Probably not, just because they haven't. Because it was only 2 weeks ago that they were doing this, so there's no real reason why they would do it again, especially this soon. They've got to see the flow and impact of their previous measures before moving again. So what does this mean for the yen? Well, essentially, if they do nothing, then and the market is expecting them to do nothing, we shouldn't see reflective price action in the yen. We'll probably see the anticipatory price action build up to a pretty much non-event. Now, if there is something to happen, obviously, if they do come out and say they're doing a lot more easing right now, we could see, the anticipation that nothing's going to happen creates this risk or this opportunity, depending on which way you look at it, that we see some yen weakness. But in saying that, we're firm believers that it's going to be pretty much non-event the next 2 days. Yet overall, we think the bias is still towards easing in Japan. I mean, if we look at the Japanese economy, one of the key things, by the way, I look at when I'm looking at the Japanese economy is the Tankan surveys, which was released earlier this week. And basically, what does that tell us? When we're looking at the survey, if we sum it up in a sentence, it basically says the Japanese economy is not doing well and it's not predicted to do well going forward. I mean, the key highlight I looked at from that particular survey was, despite the fact that it was better than economists were expecting, it was still well below what other manufacturers forecast. What manufacturers forecast in the June survey. So what that's saying is sentiment is on big downward slope there, and that's really bad. So it's not creating this room or this environment for growth friendly movement, and also growth friendly growth essentially in the Japanese economy. So what does that mean going forward? It means likely we're going to get more action from the BOJ. But if you look at it, what can really the BOJ do? I mean, they've been on this long easing cycle for a while. They've even intervened in the currency, on a couple of occasions. It just hasn't had the desired effect. And if we look at the graph here, this where the market's right now is that big intervention level we saw, around November last year, October, November last year. But if they do that again, that price action tells us and tells them, for that matter, that there is no real long-term benefit for it. I mean, yes, I guess you could argue the only really long-term benefit it had was it kept people above that 75.5 level. So again, we think that's going to happen. We think, if we do continue sort of slow downward trend in the US yen, we're going to see it drift towards 75.5. Now, as we can see, if we look here, it's sort of, it's becoming a lot more cautious as it approaches the 75.5 level. Now, we we think that's going to continue going forward if it stays on this current directory. Key thing to watch out for, though, or what we think might happen, is the BOJ will actually let it drop below that 75.5 level a little bit and kick away a lot of the orders, essentially from this particular pair, from the yen, stopping it from sinking lower. And then once that has happened, then they'll jump in and do intervention. And because all those orders are whacked out, and people will then jump on board, we'll see more profound impact to push higher towards possibly 78, 79 again. Who knows? But either way, so yeah, we'll think they might let us think about 75, 74, depending on price action at the time. But so overall, yeah, we do think the trend lower going forward as they continue, as the BOJ continues to ease, as we can see. The easing from the BOJ is just not having the side effect, especially in face of, all this risk-off sentiment throughout the market. And, now with the US announcing QE3, that creates the notion of US dollar weakness. So, that means essentially on a fundamental level, traders are going to pick the yen over the USD as a safe haven trade. I mean, if you've got this risk of devaluation from QE in the US, why would you risk that when you've got just as much of a safe haven trade, or almost as much of a safe haven trade in the yen? So, that's what essentially we think will happen if the sentiment starts to turn, especially in terms of the US. If we start to see this continual build-up of inventories in the US with negative, with poor sales figures, poor sales data, what does that lead to? Well, poor sales data, build up in inventories basically means production down the road is going to suffer. It's not going to be the sales there yet. Shops or whatever they might be, manufacturers are already going to have the inventories around to supply the sales. So production suffers, the economy slows, not good news. So if we continue to see that build up, again, that'll increase scope for more QE from the Fed, or they'll jump on and start doing, this sort of unlimited QE3 they're talking about. And that's going to worry the market about jumping into the US dollar. Now, it won't completely stop, we think, transmission into the US dollar because of its ultimate safe haven nature as the world's reserve currency, but it also creates more attractive anyway for a safe haven play, the yen. So that's what we would be looking at in the near term. Over the next couple of days, though, in terms of what happens as a result of the meeting, we don't think there's going to be that much price action. We're not expecting a surprise. When we look at the market isn't expecting a surprise either in any sort of cross-asset allocation or if in any sort of market for that matter. So we think there'll be a fairly stable price action anyway from the yen going forward. We think instead it will be more of a long-term approach to trading the yen, which is not untypical of the yen, because it does have these sort of periods of almost flatlining before it has a big move, which is quite interesting. But also the interesting thing to note from this graph anyway, is what I found very interesting is what the currency guys always say on the desk is up by the stairs, down by the elevator. I'm not sure if you guys have heard that before. But what we're seeing here is different. It's not up the stairs and down by the elevator. It's up by the elevator and down by the stairs. Now the reason why that is basically because of this fear of intervention, or this notion there's so much more policy easing in Beijing. But that doesn't necessarily mean the JPY isn't going to continue on downward trend. And if we had a look at this graph a while ago, we would have said that this sort of notion of the elevator before the stairs is a bad thing, and we might see a reversal trend and push the yen up. But nowadays, because of this sort of massive easing bias in Japan, and the fact of we can't see the fear of intervention if the yen gets too high, it reverses the role of the elevator and stairs. So we go up in the elevator, and we come down in the stairs, as we can see here. And that that does work pretty much across the board. I mean, we're looking at easing bias from almost every central bank in the world. I mean, if the Fed could ease monetary policy more, they would. In Europe, we're looking at obviously unlimited bond buying through the OMT program. Yesterday we had rate cuts in Australia, and we're looking at market anyways, not pricing another rate cut in November, and also in China. They've got some definite easing bias to boost their economy, despite what's happening with housing prices and inflation. But overall, there is still that easing bias. But all right, guys, that's about all we can go through tonight. If you have any questions, feel free to ask them. They don't have to be about what I've gone through in this webinar. They can be about commodities or whatever you feel necessary to go through. But if you don't have questions, thanks for attending, and hopefully we'll see you next week.